Let's begin with mastering inventory. This is another in our series of textbooks. Inventory is goods that a company owns. And we're looking at manufacturing companies. Manufacturing companies acquire raw materials and or parts to produce finished goods. Some examples of manufacturing companies include Toyota, Coca-Cola, Papa John's. There are three kinds of inventory with a manufacturing company: the raw materials, the work in process or work in progress, and finished goods. With a merchandising company acquires goods for resale to customers. Examples of companies include Walmart, which sells household goods, TJ Maxx that sells clothing, and Ralph that sells groceries. In addition, there are wholesalers and distributors that act as merchandising companies. This textbook, will focus on merchandise inventory. The subject of manufacturing inventory is typically covered in managerial or cost accounting. Now, recording purchases. Purchases are booked when legal title passes to the buyer. When title passes depends on the terms of the contract. Title is passed in one of two ways. When goods leave the seller's location, FOB shipping point is the term. Free on board, FOB stands for free on board shipping point. When goods arrive at the buyer's location, it's FOB destination, free on board destination. Goods in transit must also be accounted for at the end of the period. In summary, FOB shipping point, title passes when the goods have left the seller. Goods in transit belong to the purchaser and must be recorded as inventory on the purchaser's books. FOB destination, title passes when the goods have arrived at the buyer's or the purchaser's location. Thus, the goods in transit that are in transportation still belong to the seller and must remain on the seller's books as inventory. Purchasers include in the cost of inventory the purchase amount, that is the actual amount paid, not just the price in the catalog or on the purchase order. The cost of inventory also includes any transportation costs, any freight, insurance costs paid by the buyer under the terms of FOB shipping point. Let's look at this situation where we have Orco buy some inventory, and for each purchase below, we're to indicate whether Orco should record the items as inventory at year end, and if so, for what amount. Now remember, we're looking at Orco, and Orco is the buyer. Let's say that there are goods that list for $1,400 that Orco gets for $1,200 under the terms FOB shipping point. Shipping is $100, and at year end the goods are in transit. So they're somewhere being transported from the seller's point to the buyer. But under the terms FOB shipping point, title passes to the buyer. So while they're in transit, the buyer, the purchaser, owns them, and the buyer is responsible for the shipping. So in this case, the answer is yes, we should include the goods in inventory. And the cost of the inventory is the cost, $1,200, that was paid, plus the cost of shipping, so $1,300. Goods costing $1,000 under the terms FOB destination, shipping is $200. At year end, the goods are in transit. Orco is still the buyer, but the terms are FOB destination. So the goods remain the property of the seller until they reach their destination. They have not reached Orco by year end, December 31st. So therefore, no, we do not include the goods in inventory, so there is no cost to report. Goods costing $800, FOB shipping point, freight is $50. At year end, the goods have not been shipped. So here's a situation for Orco that they've placed the order, but the goods have not been shipped. So the goods have not passed from ownership. The title has not passed from the seller to the buyer. Orco does not own these. So the answer is no. If they had been shipped at year end by December 31st, then we would have said yes and recorded the cost as $800 plus the cost of the freight, $50. Alright, inventory is reported on the balance sheet as a current asset. Inventory is not presented on the income statement because it is an asset. It may appear in part of the calculation of the expense, that portion that's set aside as the cost of goods sold, COGS, and it could be illustrated particularly through periodic inventory, where we take the beginning inventory plus the purchases equal the goods available for sale, subtract the ending inventory, and that equals cost of goods sold. Inventory records may be kept in one of two ways: the perpetual method and the periodic method. Under the perpetual method, transactions affecting inventory, such as purchases and sales, are recorded in the inventory account as they occur. With perpetual inventory, any transaction that affects inventory, a sale, a purchase, a return, with each and every transaction, inventory is updated so that we know at any point in time how much and what the dollar amount of the inventory is. Periodic inventory, with it, transactions affecting the inventory are recorded in temporary accounts. The balance in the inventory account does not change until year end. At year end, we'll have to make an adjusting entry to update the balance for the inventory. Purchases. With perpetual, we will debit inventory and will credit cash if we pay in cash, or we'll credit accounts payable if we charge it, if we purchase it on credit. With periodic inventory, we debit purchases, which is a temporary account, and then we credit cash or accounts payable. Under the perpetual method, the shipping costs paid by the purchaser are also recorded in inventory, which is the asset account. So anytime that we're paying for the shipping, the freight in, we would debit inventory and credit cash or accounts payable. Under the periodic inventory method, the shipping costs are recorded in a separate freight in account, a temporary account that we'll be using, and therefore we would debit freight in and credit cash or accounts payable. Sales. Under perpetual sales, when we sell, we have to record two journal entries, one for the sale and the other for the cost of the sale. So the first entry is to debit cash or accounts receivable and credit sales. The second entry is to debit cost of goods sold, which is an expense, and to credit inventory, the asset, because we're removing inventory to sell it. Under periodic, we simply do one journal entry where we debit cash or accounts receivable and credit sales. So under the perpetual method, both the inventory and the cost of goods sold account balances change every time there is a sale. Under the periodic method, neither the inventory nor the cost of goods sold accounts are affected at the time the sale is made. Those will have to be adjusted later. Sales returns. Using perpetual, a sale return is a contra sales account, so we debit sales returns and we credit cash or accounts receivable. We also have to have a second journal entry where we debit inventory, because the item coming back, or items, will go back into inventory as long as it's in usable form and we can resell it, and we credit cost of goods sold. Under periodic, we simply debit sales return, which has a normal debit balance. Contra sales means that it is the opposite of the sales account, which has sales revenue, has a credit balance. And we also credit cash or accounts receivable. We do not adjust the inventory account balance. No entry was made to inventory when the sale was made, therefore we're not making one now. Once again, we'll have to adjust inventory and the various accounts when at year end. Here we have an example. Orco sells some goods for $600, but the customer returns the goods before paying the bill. The units cost Orco $400. We're to record the return under the perpetual and the periodic methods. So under perpetual, we would debit sales returns and credit accounts receivable. We would also debit inventory and credit costs of goods sold. The amount for the sales return is $600. That's what we sold it to the customer for, so we're taking it off their account. And the cost is $400. So that's what we're putting the item or items, the goods, back into inventory at and taking out of cost of goods sold. Under periodic, we only make the one entry where we debit sales returns for $600 and credit accounts receivable for $600. Purchase returns. Under perpetual, we debit cash or we credit accounts payable and we credit inventory. Because when we return, we're taking it out of inventory, sending it back, and we either get cash or if we have not paid for it yet, we will reduce the amount we owe in accounts payable. It's simply the entry is simply a reversal of the original entry. Under periodic, we would debit cash or accounts payable and credit purchase returns. Purchase returns is another temporary account. It is a contra purchases account. Purchases has a normal debit balance and purchase returns has a normal credit balance. We would also debit cash or accounts payable and credit freight in for the cost of the shipping, the transportation. Purchase discounts. Well, suppliers may offer trade discounts, and these are normally based on volume or on the nature of the business relationship between the buyer and the seller. Purchases that include a trade discount are recorded net of the discount. Gross method. The cash discount is ignored at time of purchase, so the full invoice price is recorded. If the invoice is paid within the discount period, the payment will be less than the amount in accounts payable. Under perpetual, if we owe accounts payable of $1,000, we would debit $1,000 to accounts payable. We have a discount of 2%. That would be, we would credit inventory for the discount of $20, and we would credit cash for the net amount of $980. This reduces the $20 in inventory reduces the dollar amount of the inventory to reflect the discount. Under periodic, we debit accounts payable for $1,000 still. We credit purchases discounts, a temporary account that is the contra purchases account, $20. It has a normal credit balance, and we pay cash of $980. So keep in mind, under the perpetual method, the discount amount reduces inventory. Under the periodic method, the discount amount increases purchase discounts. The cash discount is ignored at the time of purchase, so the full invoice price is recorded. If the invoice is paid after the discount period, the payment will be the amount in accounts payable. So here we have a situation where we recorded the full amount even though we were offered a discount. We missed the discount period, so we're paying in full the $1,000 and crediting cash. Under periodic, we would do the same. So same entry under perpetual and periodic. Here's an example. We have Burton Company purchases $4,000 of inventory with invoice terms of $210 net 30. That's 2% discount if paid within 10 days of the date of invoice. Net 30 means that it's due in full in 30 days. We're to prepare the journal entries for the purchase and payment if, first of all, Burton pays within the discount period. Well, the perpetual method would be for the gross method, to debit inventory for the full $4,000, credit accounts payable. To record the payment, if within the discount period, we would take 2% times $4,000, and that would give us $80. So we would have to record it this way. Debit accounts payable for $4,000, credit inventory in the amount of the discount, which is the $4,000 times 2% or $80, and credit cash for the balance, the $3,920. Under periodic, we would debit purchases and credit accounts payable. The payment would be a debit to accounts payable for the full $4,000, a credit to purchases discount for $80, and a credit to cash for $3,920. Gross method example continues. Same story. It's Burton though, and they're paying after the discount period. Well, that means we owe the full amount. So here's the purchase. It is to debit inventory $4,000, credit accounts payable $4,000. We saw that previously. Here's the payment. The payment is no discount. Accounts payable debited $4,000, credit cash for $4,000. Under periodic, we debit purchases, credit accounts payable, and the payment is a credit to accounts payable, a debit to accounts payable, and a credit to cash.